What I want to do is sort of quickly lay out the history, how we got here. I actually spent most of my time how we got here, and I want to say I'm going to be bipartisan here because my story begins with the Clinton years. So I could be bipartisan in saying what the troubles were. Just say a little bit about how we move forward, and then I want to say some how we get out of the problem. A little bit about how we think about it, and basically I'll come back to this. But one of the things that really irks me is that this is often put as an issue of regulation versus deregulation. And what I always say is that there's no deregulators here. There are no free market fundamentalists. The free market fundamentalists just want the government to hand money to the rich, and I'll come back to that. You know, and I think it is a very important point, both because it's true, but also politically and how we talk about it, how we think about it. Okay, well, the basic story. How do we get the bubble economy? Just very quickly, you know, I always talk about the golden age. It's not just me, many others make this point. We can look back to the post-war period where you had sort of this nice story where we had prosperity that was broadly shared, that the economy grew very rapidly in the 3 decades following World War II, and everyone benefited, everyone shared. I don't mean to say it's a great time or anything, but you could look up and down the income ladder and you were seeing wage gains. People were sharing in the benefits from growth. That ends in the 80s. I won't go into all the stories there, but Ronald Reagan's the bad guy in my story, but other things too. But in any case, it ends in the 80s. We get to the 1990s. We get our new young president in office, President Clinton, and the question is, what's he going to do? What are going to be his priorities? Some of you can remember back to his campaign. On the one hand, he had the putting people first agenda, invest in people and infrastructure, education, training. The other hand, he had the deficit reduction people, the Robert Rubins, the deficit hawks. Get the deficit down, get interest rates down. That was the way to grow the economy. Well, that was the side that won out, of course. We saw very little by way of investment in people and infrastructure and research and development. We saw a lot by way of deficit reduction. And what did that do? Well, my argument is that that laid the groundwork for the bubble economy. Because if we go back and we look at the years 93, 94, 95, 96, the economy did okay, but no one in 96 would say the economy was anything great. The economy began to really take off in the late 90s. And why did it take off? Well, on the one hand, we did have this boom in productivity due to computerization, but the real driving force of the economy in the late 90s was the stock market bubble. Okay, so we go back and we look at what really drove the economy. There was not any huge upturn in investment. Again, the Clinton people, if I had them here, they'd probably be jumping up and down. Maybe you have some Clinton people here, but they'd probably be jumping up and down, yelling and screaming, but the fact is they're wrong. There was no huge upturn in investment. There was some increase in investment, but it wasn't terribly impressive, and in fact, much of that upturn in investment was the dot nonsense at the end of the decade. The real driving force in the economy in the late 90s was not an uptick in investment, it was an uptick in consumption. Why did we get an uptick in consumption? Well, we had on the order of $10 trillion in stock bubble wealth. Okay, and there's a well-known wealth effect. It's not something that I invented. You know, economists talked about this when I was in grad school some time back. It goes back probably 50, 60 years. The idea that if you have a lot of wealth in stock, you'll spend based on it. 3 to 4 cents on a dollar is a conventional estimate. Okay, so if you have $10 trillion in stock wealth, the conventional estimate would tell you you'll spend 3 to 4 cents, that's 300 or 400 billion a year. At that point, that was 3 to 4% of GDP. That was what was driving the economy. The big growth, if we look at what sector of the economy grew, what component of demand grew in the late 90s, it wasn't investment, it was consumption. Okay, so there was this big consumption boom, the saving rate plummeted. That was Clinton era. Okay, that was the stock bubble. Okay, so that was the beginnings of the bubble economy. We had a lot of good things you could say about the late 90s. We got 4% unemployment. That was great. Most economists thought that was absolutely impossible back in the middle of the decade. I had a lot of arguments with economists who ridiculed me for thinking the unemployment rate can get down to 4%. So we got the unemployment rate down to 4%. What that meant was not only a lot of people had jobs who wouldn't have otherwise, and disproportionately that low unemployment is benefiting people who are hardest hit otherwise, low-income people, blacks, Latinos. We had a much lower unemployment rates for those people than most people ever thought possible. And we saw wage gains for the first time since the 60s, wage gains up and down the income ladder. So a lot of good things you could say about the late 90s, but what you couldn't say was that it was sustainable because it was driven by this bubble. It was driven by a stock bubble, and bubbles burst. Okay, so 2000, we get the peak of the NASDAQ at 5,000. The S&P at that point peaked at a little over 1,500, and it plummeted. Okay, so we got the recession 2001, 2002. And that, if you talk to most economists, they'll go, oh, well, that was really a very, very mild recession. Okay, well, that's not really true. If you look at the recession, at least the dating of the recession, sure, the official dating of the recession, it begins in March of 2001. It ends in November of 2001. That's about as short as a recession could possibly be, 7 months. But the reality, at least for where people are, most people live, what matters for people is, can you get a job? And the reality was, we lost jobs not only through 2001, we continued to lose jobs all through 2002. We actually didn't start creating jobs again until the fall of 2003. Okay, the economy was dead in the water. Okay, so it was actually a very severe recession. Let me mention another part of why it was such a severe recession I'll come back to. We had an overvalued dollar. Again, this is a Clinton-era policy that at least under his second Treasury Secretary, Robert Rubin, they thought a high dollar was a good thing. And that continued under his successor, Larry Summers, who, as we know, is currently in a high position in the Obama administration. They thought a high dollar was a good thing. What that meant was that we had a very large and growing trade deficit. One of the factors that ordinarily would have helped us coming out of the recession went the wrong way in 2002. So instead of seeing an improvement in our trade situation actually deteriorated because of the overvalued dollar. Again, that was a deliberate policy in the Clinton era. It was held over into the Bush administration. Okay, so we have a very weak economy, 2001, 2002, into 2003. What finally gets us out of that recession? Bubble number 2, housing bubble. Okay, and how did we get the housing bubble? Well, the housing bubble actually began in the 90s. It wasn't necessarily that big a deal in the 90s, but what the basic story was, when we saw all this wealth being created in the stock market, as I said, people spend based on their stock wealth. They go and buy more of all sorts of things. They get a new car if they made a lot of money in the stock market, take a vacation. One of the things you might reasonably do if you made a lot of money in the stock market is to get a bigger house, better house. At least in the short term, supply of housing is relatively fixed. So suddenly you have a lot of people made a lot of money in the stock market. They go out and look for a bigger house, and there aren't bigger houses out there, so they bid up the price. And that starts in the mid-90s. So what you see is that there's a 100-year-long trend where for the nation as a whole, house prices just keep pace with the overall rate of inflation. So if you look from 1895 to 1995, as a national average, house prices just kept even with the rate of inflation. Again, huge regional differences. We could point to New York City or California, places where prices did rise much more than the rate of inflation. But as a national average, house prices just rose at the rate of inflation. That begins to change in the mid-90s. Okay, by 2002, when I was first began noticing it, began noticing, I'll give Alan Greenspan credit here, I began noticing it because Greenspan gave testimony to Congress saying there was no bubble, and not everything he said didn't make any sense. So then I started looking at the data more carefully, and I looked and said, yeah, there is a bubble. The basic story, by 2002, house prices had risen about 30% above the rate of inflation, 30% in excess of the rate of inflation. At that time, by my calculation, that corresponded to about $2 trillion in housing wealth. Now, that continued, housing bubble wealth. That continued up until the peak of the bubble in 2006. So what kept it going? Well, I would argue that was probably conscious policy. We should go back and we'll have opportunities to see this when the Fed's transcripts are made public. It's done with a 5-year lag to see what they knew at the time. But the basic story was they needed something to get the economy out of this 2001 recession that was lingering through 2002, 2003. Recall the interest rates at that point were 1%, which everyone thought was very low. I mean, obviously there's 0 today, but the federal funds rate was pushed down to 1%, which was slower than anyone thought it would ever get. And the economy was still going nowhere. The one sector of the economy that was dynamic was housing. Okay, so Greenspan, again, what he consciously did, he didn't discuss with me, but I would say they seized on the housing bubble as the one source of growth in the economy. So what happened was housing itself was a big source of growth because housing grew to be over 6% of GDP at its peak in 2005. So ordinarily, historically, housing's been about 4% of GDP. It grew to be about 6%. What does that mean in plain English? That difference is over $300 billion a year in annual demand, 2 percentage points of GDP. That gave a big boost to the economy. More importantly, it eventually led to about $8 trillion in housing bubble wealth. And just as I said, there was a wealth effect based on stock, there's also a wealth effect based on housing. The estimates of that effect are even greater, primarily because more moderate income people own houses than stock. So the estimate of the wealth effect is 5 to 7 cents on a dollar. What that means is if I have $1,000 of housing wealth, I'm going to spend $50 to $70 more each year on consumption than would otherwise be the case. So you do that arithmetic with $8 trillion, you get $400 billion to $560 billion a year in additional consumption. And again, if we look at the data, we see that the savings rate basically fell to 0. By some measures, it actually went negative during this period because people were spending based on their housing wealth. And by the way, I should point out, this is a perfectly reasonable thing to do. I listened to a piece on NPR, which I trashed on my blog this week, because they said, oh, we were just borrowing like crazy. Well, it was a perfectly reasonable thing to do if you were listening to the experts on NPR and they said there was no housing bubble. Because why wouldn't you? You just saw your home go from 200,000 to 400,000. Why wouldn't you take 20,000 out and pay for your kids' education, buy a car, take a vacation? Why not? What's wrong with that? You know, it was only people like me who were going, wait a second, there's a bubble. So that was what was driving the economy. That's what sustained our growth through these years, through 04, 05, 06, 07, into a modestly healthy recovery. It wasn't great, but we did get the unemployment rate down to 4.5%. We did begin to see some wage growth. Okay, so that was the basic story there. Now, should they have seen a bubble? Well, let me just very quickly tell you some of the things that should have been jumping out at them. When you see a divergence from a 100-year-long trend in a basic market like housing, that should send some alarm bells off. I mean, if we're looking at some obscure metal, I don't know what qualifies an obscure metal, platinum, calcium, I don't know, whatever. Something that isn't terribly widely used, and we saw the price just went up 70%. Well, maybe there's something in supply and demand. Housing is not obscure. Okay, so you see an increase in 70% in house prices. You'd think the detectives, overrunning economic policy would go, well, what led to that? Was there something on the demand side? Did we suddenly get a huge increase in population? We know that. Was there really great income growth? I think we know that too. We had good income growth in the late 90s, not extraordinary. It wasn't greater than what we had in the 50s, 60s, and early 70s. But on top of that, once we had the recession, we had no income growth. Income was falling. So those stories didn't fit. Okay, was there a problem on the supply side? Greenspan said, well, because of environmental restrictions, you couldn't build. Well, this wasn't exactly the heyday of environmentalism. I remember the Republicans took over Congress in 94, controlled most of the state houses. It wasn't exactly the heyday of environmentalism. But the other thing you could do is you just look at the data. We were building housing at near record rates. So obviously there was no story on supply or demand side. So you got a 70% increase in house prices and no explanation on supply or demand side. That might have you thinking something's wrong. So you go, okay, well, let's ask another question. What about the rental market? If it's the fundamentals of supply and demand in housing, well, at the end of the day, people do make choices. I mean, not that everyone's going to sell their home because they can get a better deal renting, but people move into an area, the new families get formed. So we expect those markets to move together. In general, they do. So what was going on with rents? Answer, nothing. Okay, rents rose a tiny bit more than the rate of inflation, about 5 or 6 percentage points more than the rate of inflation through the late 90s. In this decade, they've actually been falling a little bit, adjusted for inflation. So you go, okay, you got this big run-up in house prices. What's going on with rents? Nothing. Might have raised more concern. Okay, another issue that might have raised concern. Vacancy rates. Supply, demand, I learned that, I think you have to learn that if you go to grad school anytime these days. Okay, well, there's huge vacancy rates. There's a big surge in vacancy rates in rental housing. That was in the early part of the decade. That eventually flipped over into ownership units. So we now have record rates of vacancy rates in ownership units. That was first apparent by the end of 06. Okay, so originally it showed up on the rental side, then it showed up on the ownership side. And of course, it's not set in stone what's a rental unit, what's an ownership unit. If you're sitting there, not too many people are going to sit there like an idiot. They've got their rental unit that they can't rent. It's sitting vacant forever. They see ownership prices are going through the roof. If they figure out, well, why don't I turn it into a condo? They are one market at the end of the day. You can't do it overnight, but you can do it. So vacancy rates, another factor. Okay, well, what else was going on? Bad mortgages, not a secret. Greenspan's going, God, I wish I knew about that. Subprime has been around. I don't know how far back it goes. I should look this up sometime so I don't have to say I don't know how far back it goes. But it certainly goes into the 80s that we had these loans categorized as subprime. The more risky loans tend to be lower income people with more questionable credit histories. Typically 6, 7, 8% of the market. That jumps to 25% of the market in 2006. Okay, what's going on that you suddenly have this category of loan that triples as a share of the market? Alarm bells should have been going off. Okay, another category, this category Alt A, it's an intermediate category, tends to be taken out by small business people, primarily because they lie on their tax returns and can't fully document their loans. That goes from 1 or 2% of the market to 15% of the market. Are there more liars out there? Maybe, but that should have led people to realize something was wrong. Okay, and I should just say, I used to get emails from people all over the country about their brother-in-law is a loan officer or their friend's a loan officer, and they're being told by their bosses to fill in numbers for people so that they can qualify for mortgages. I don't have any regulatory authority. Now, I can't believe that the people with regulatory authority did not know about this. And again, any one of those, 2 of those, 3 of those, they all could be making up stories. But when you get this from all over the country all the time, they can't all be making up stories. We know now, of course, they weren't. So the idea that they didn't know this was absolutely incredible. Okay, so what happens, of course, bubbles burst, and that's what happened here. None of this should be the least bit of a surprise. We've lost $8 trillion. At this point, we've lost about $6 trillion. Well, we're on our way, I'm sure, to losing at least $8 trillion. We might overshoot, might lose $10 trillion, who knows. It looks pretty bad. And that, on the one hand, leads to collapse of the housing market. It had been 6% of the economy. It's down to 3%. That translates into $450 billion a year in lost demand. Okay, we've lost all this housing wealth. We've lost, let's just start with $6 trillion. $6 trillion in housing wealth. That's going to lead people to consume less. They have no option in many cases. People in many cases have been borrowing against their home. Well, you can't do that if you have no equity. Okay, somewhere around 20% of mortgage holders are now underwater. So a lot of people have no equity. Who did have equity a couple years ago. Can't borrow against their home. Other people, maybe they still have some equity, but they're realizing that they're getting near retirement and they don't have any money. Okay, so people are saving. You know, in many ways that's a good thing. On the other hand, from the standpoint of the economy, that's a really, really bad thing right now. Okay, so we're lost somewhere in the order of $400 billion a year in annual consumption, and we're probably going to lose more. So my best is that we're going to see annual consumption fall in the order of $600 to $700 billion because of this loss of wealth. By the way, we also lost about $7 trillion in the stock market. Okay, on top of that, I'll just mention in passing, we had a commercial real estate bubble that came up about 06, 07, in the wake of the collapse of the decline of the housing bubble. Commercial real estate bubble, that also is going to collapse. Okay, my total estimates of the loss of demand that we're going to see are on the order of 1.3 trillion. I'm just saying this in passing because I want to point out, however much I like a lot of what the Obama administration is doing, their stimulus package is a good start, but it's not going to go very far because against the 1.3 trillion loss in annual demand, their stimulus package translates into about 350 billion a year in annual demand. Okay, so that's a start, but that's not going to replace the gap. Okay, so we're looking at a very, very scary situation, and I won't go into great detail here, but I think the answer is, as I keep saying about this, it actually really is remarkably simple. It's we have to spend money, and we have to spend a lot of money. And the idea that somehow we should be concerned about this is close to crazy. I was being interviewed by a number of reporters last week about President Obama's budget, and invariably they would ask me about the economic assumptions. They go, well, they're kind of optimistic because, you know, they're looking at an unemployment rate at the end of the year that I think is about 8.5%. I forget the exact number, something like that. I'm worried we're going to see an 8.5% unemployment rate in March, and it's not going to stop there. It's going to keep going. You know, so I think that's a very optimistic assumption. So they said, so you think the budget deficit might be worse than he's projecting? And I thought, well, this is a little screwy. I mean, if you envision, I mean, both from the standpoint of the economy, obviously they're all concerned about being reelected. I really can't imagine that President Obama is going to want to run for reelection in 2012 with a 12% unemployment rate, but go, I balanced the budget. So the idea is just kind of remarkable. I realize I'm like in a different world from these reporters. I'm going, yes, it's probably worse than they're saying, and that's a good thing that we're going to have bigger deficits. Whereas they're all appalled, oh my God, the deficit's going to be bigger. You don't worry about deficits in this context. Let me just say one other thing on that topic, and then I'll just finish with my diatribe about regulation. We have this guy, Pete Peterson. Have people here heard of Pete Peterson? Okay, those of you who haven't, this guy's made a fortune on Wall Street, I think around several $billion. And he's decided to use much of his money to set up a foundation that, to put it crudely, at least in my view, it's dedicated to cutting Social Security and Medicare. And they talk about intergenerational equity. Now, I won't go through my whole diatribe because I can go at great length on this because I've been writing about this a long time. One of my prior books was on Social Security. But intergenerational equity, okay, we're worried about our children and grandchildren. We should be worried about our children and grandchildren. But let's look at what just happened. We just saw the destruction of, on the order of $8 trillion in housing wealth. We're another $7 trillion in the stock market. Okay, could probably have about half that much again in small businesses that we just lost. None of those are owned by young people. Okay, this was a loss of a huge amount of wealth by people in their 40s, 50s, 60s, people who are already retired or will be retiring soon. The Peterson people have not changed what they say one iota. This is a loss of wealth, and I should point out it's a gain. This might sound perverse. I'll explain in a second. It's a gain to the younger people. Why is it a gain to younger people? Well, actually, it's fairly simple. Everyone who owns a house and just saw half the value disappear. Well, guess what? If someone comes along in their 20s or 30s, they get to buy the house at half the price they would have paid 2 years ago. Okay, so all of us, it's a mostly older group here. We all, you know, I'm a renter, I'm okay here, but you know, we just saw the price of our house fall by you know, not 50% in most cases. In some cases, it would be 50%. Well, our kids or, you know, grandchildren, whatever, they're going to pay half as much. Same is true with the stock market. You get to buy stock at half the price you would have paid a couple years ago. We've had this incredible intergenerational transfer from older people to younger people, but yet you have this damn foundation committed to intergenerational equity, and they have not noticed. How can you take them seriously? Okay, well, I'll just stop on that one. Let me just say one point about the regulation, deregulation issue, and I think this is very, very important. The bad guys in my story, and again, it's bipartisan, so it's both. We got Robert Rubin, Alan Greenspan, Henry Paulson. We got both people on both sides here. No one wanted deregulation. What they wanted was what I often refer to as one-sided deregulation. They all wanted the safety net of the government there to bail them out. None of these people got up and said, no, 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 don't have the government come to city's aid. Don't go to AIG's aid. None of them said that. What they wanted was this government insurance policy called too big to fail, and they didn't want to have to pay for it. It's not free market fundamentalism. That's rip off the taxpayer. Okay, so we give them way too much credit if we ever call them free market fundamentalists. They're not. They're about taking money from Joe the plumber and giving it to the richest people in the country. So we should be really clear on that. So I stop. I've probably gone on longer than I should, but I'll stop and take questions.
I just want to begin with a comment and then a question. Your comment about intergenerational equity reminds me of what Groucho Marx once said. Why should I care about posterity, he said.
What did they ever do
What's
for us?
posterity ever done for me? But the question I have is, where do we go from here? It seems to me that there should be a congressional committee, a very serious one, not one that provides a platform for grandstanding senators and congressmen to complain about the greedy bankers, but to actually go into the nuts and bolts of how this disaster occurred. I mean, for example, you might ask Ken Lewis, if I were on that committee, you might ask Ken Lewis, what kind of due diligence did you perform when you bought Merrill Lynch, and within a few months or weeks after you bought it, a $15 billion loss is revealed? I mean, forget about the $35,000 commode, the $80,000 area rug that John Thain bought. I think that's a distraction. I mean, if he had produced a $15 billion profit, no one would have cared about those rugs and commodes. But the real important number is the $15 billion loss within 2 or 3 weeks after buying that company. I mean, how can you call yourself a responsible banker when you buy a company like that, which is essentially bankrupt? And this goes for some of the other big shots, you know, Bear Stearns, AIG. There's an article in today's Times by Nocera, or yesterday's Times by Nocera, about what AIG was doing. It's just incredible that the leverage, I think here the regulators did play a role. I mean, the leverage went to 30 to 40 to 1. This is just unbelievable. It violates every principle of banking. I think there should be a kind of truth commission that will follow up and discuss these issues. So
we have a lot of people in line. Keep the questions.
Okay, a quick thing. I mean, I think it'd be great to have a truth commission, but you know, unfortunately, when you say it shouldn't be grandstanding senators, I think that's the only type. You know, it would be really good to get at the bottom of this. I mean, I have to scratch my head. I mean, when they bought Merrill Lynch, I was going, well, look, I'm not there. I don't have access to their books, but the idea that there were huge losses there, it seemed pretty obvious to me. But you know, I thought, oh, maybe they know something I don't. Well, they didn't. You know, I don't, but they get paid a lot more money. It's their job. It's not mine. I don't really understand, and you know, there are a lot of decisions that were made along the way where it's just almost impossible to imagine what these people were thinking. So I think it would certainly be helpful to try and get them out there and say what they were thinking. The other part, by the way, I do think it matters. I'm very, very happy to see their executive pay called on the carpet, because this is, to my mind, this is, I think, a really important thing that's gone on in the last 30 years or so, that we've seen this explosion of pay at the top, and nowhere more so Wall Street. And it sets a pattern. So you see these guys on Wall Street, they're getting 30, 40, 50 million a year. That's certainly what, you know, common for those at the top of the, and some even get more than that when they have a good year, you know, the traders. And what happens is the other CEOs of other companies, this guy at Tyco, I forget his name now, who's now in jail. Yeah, Kozlowski, he was ripping off his company, and he supposedly said, well, the reason why I'm doing this, he's getting like $15 million a year. The guy who handled their bond issues, I guess a young guy in his 30s, goes, this guy's getting $30 million a year. And it just drove him nuts that, here he is, he's worked his way to the top of this big company, and some punk is getting, so it sets a pay pattern, and it permeates everything. So you have presidents at universities. I was having exchange with someone, I realized that, at the top university got $1 million a year. Well, a lot of the not top universities, you get $1 million a year. So it sets this pattern that throughout the economy that I think we really have to beat down. So I think it's great if we can get these guys on Wall Street to say, look, you're going to take pay cuts, you're going to take really big pay cuts, you're going to have to live with the proletariat and $500,000 a year, and that will set a pattern. I think that's a really, really good thing.
You mentioned the loss of $15 trillion in wealth without really mentioning that people borrowed money to acquire all that stuff, and now the assets have collapsed, but the liabilities remain. And in the recovery plans, it's always talk about recapitalizing the banks without acknowledging the fact that banks need to have creditworthy people to lend to. And it seems to me that there are no creditworthy people anymore, not just in this country, but the whole world. Everybody owes more than they can ever repay. So the world is bankrupt.
Yeah. Well, remember, everything is owed to someone. What we need to do is a recasting of debts.
Well, this is really my question. Is it possible for us all to be in more debt than we can ever repay? All of us?
No, because someone has to own that debt. Someone somewhere.
So, like a couple people do.
Well, no, it's not quite that way. But let me point out, there's been this unwillingness to talk honestly about the bailouts. So there was a legitimate public interest. I was one of the most ardent opponents of the TARP, so I don't want to be labeled as a supporter of it. I was out there arguing to the very end it was a bad idea. I understand why people in Congress voted for it, because they would have been beaten up no end by the media if it went down, and they had voted against it. They'd be blamed for it for every bad thing that happened. But the TARP, the justification for the TARP is that there's a whole chain of liabilities that if that collapses, we don't know where that ends up, because the banks owe money. Their creditors are pension funds, or 401ks, or money market mutual funds. We don't know where that ends up if that just collapses. That's a very, very scary story. So I'm sympathetic to keep that from collapsing. And on the other hand, we have zero interest in making sure that these guys running the banks can continue to get their seven-figure salaries. That's why it's totally appropriate to go, look, you're coming to us for money. You're going to get by at $500,000. That's it. End of story. No games. That's it. $500,000. We don't care whether it's bonus or some sort of long-term compensation. Live on $500,000 or get a new job. And the other part of the story is the stockholders. They should take a hit. That's it. You invested. You're supposed to be smart people. You take a risk. If your bank stock did very well, as it did a few years ago, great. You made lots of money. Your bank is now bankrupt. That's again this whole issue about nationalization. We're not talking about nationalization. We're talking about bankruptcy. Like when a company goes bankrupt, we don't say it was nationalized. But that's what we're talking about here. So in any case, I think we have to bail out the banks in the sense of making good on certainly their deposits. We have a legal obligation to do that. We probably want to honor much of their liabilities to unsecured creditors for reasons of maintaining a banking system going forward. But we have zero interest in protecting the shareholders, zero interest in protecting the executives. And, at the end of the day, we have a lot of people. I should say that the idea that this house somehow is going to get the flow of credit going, no, there aren't creditworthy customers. So you have people that, a couple years ago had tens of thousands of dollars, over $100,000 in their home. Sure, bank's very happy to give them a new credit card, give them a small business loan. They have good collateral. Today they have zero equity. They're underwater. They're not a good customer. And the bank's going to be reluctant to give you a loan even if their vaults are chock full of money.
Two questions. One, is in all this mess, is there another bubble going on now? And if so, what is it? And the other is, those of us who are still working and have a little bit of cash, should we be spending too, as you're advising the government to spend?
Well, taking the second point first, I'd never tell anyone to do something that's not good for their own finances. So it's the government's responsibility to get the economy going, not individuals. So people are worried, should I be putting money aside for my kids' education or my retirement, or try to do a patriotic thing? put the money aside. I mean, someone actually wrote a piece, David Leonhardt, who I alternate between hating and really liking. He's here. Anyhow, he wrote a good piece saying that you can spend in ways that affect investments. So you could do something like make your house more energy efficient. So that will create jobs and save you on your heating bill. So there's things you could do like that. That if you really want to think, how can I do something, do my little part to help the economy and not hurt myself? There are things you could think of like that have that character. Now, the other question, remind me again quickly.
Is there another bubble?
Oh, is there another bubble? There's two, I'd be a little hesitant to call them bubbles, but two things to look for. One, the dollar will fall at some point, and I think this is really important. The dollar was overvalued and was on the way down earlier this year. It had more to go, and the measure of the dollar being overvalued is really simple. We have a trade deficit. That's the correction. How do you correct a trade deficit? You get the dollar down. Okay, it will happen at some point. Now, I worry that when it does happen, we're going to get all these people yelling and screaming, go, oh my God, the dollar's falling. That's because we have these big budget deficits. We got to get curtailed. But that's nonsense. The dollar will fall. That's a good thing. And we should be happy when it falls because it means that we're going to improve our trade situation. On the other hand, if you're betting on the dollar staying up there, you're going to get hurt. The other one that's, again, I wouldn't call it a bubble, but people are likely to get hurt some. Long-term government bonds, when you see a 3% interest rate, I don't know anyone who thinks that's going to persist. You get a big capital loss. Let's say that the long-term interest rate goes to 6%, which is still relatively low. You're going to take a very big capital loss if you're holding a 30-year bond and the interest rate goes from 3% to 6%. So I wouldn't quite call those bubbles, but those are going to be disruptive in some sense to the economy.
It's great the way you can cover so much material so quickly. It's fabulous. So let me throw a few questions.
Thank you very much time.
One, I'd like you to comment on the Federal Reserve and the fact that it's really a privatized institution that caters to the banks more than the rest of the public. That's a big problem. Two, I don't think our metrics, i.e. always looking at growth as being a central metric of how we judge the wellness of the economy. We need something sustainability, distribution of wealth and income and so forth. And the final question is, we may have hit a very, very serious tipping point in the overall wellness of the economic situation. And the ordinary curative measures might not even be appropriate. They could do as much damage as they do good. And that could be very serious. We could be in a new period of economic situation that is far different than we've dealt with, even in the Depression.
Okay, well, first off, the question about the Fed. The Fed's, of course, a weird institution. You take, I always learn new things about the Fed. I didn't know that, for example, Bernanke last fall started buying up the commercial paper non-financial corporations. I never knew the Fed could do that. That was news to me. It's a weird public-private mix. That's not, I think, the biggest problem, though, because let's compare this to Europe, where the central banks are public. They're fully public. I think the biggest problem is a lack of political control, because there's been this conscious effort to make the Federal Reserve Board or central banks more generally independent of political control. On the one hand, I do like the idea that I don't want the members of Congress setting the interest rate. That's right. We want that, I think. Just like we won't want them deciding, micromanaging the National Institutes of Health, deciding who gets this grant or that grant. That makes sense. On the other hand, the National Institutes of Health have to be answerable to Congress. They have to go and get their budget each year and say, here's what we did. The Fed should be more answerable to Congress. That's partly Congress's responsibility, that they have to be more awake and following it. The media should be paying more attention to it. They have to be more answerable. And that's true for central banks across the board. In Europe, they're much more insulated from political control. They have to be answerable to elected officials. That's a really, really big problem. And they are answerable to Wall Street. And that's, I'd kind of like to get the Fed, get all this away from the East Coast, put them in, it was another talk, I said Kansas City, I said not Kansas City, but somewhere, put them in Oklahoma or somewhere, get them away from the financial centers, so they have less influence. The second point, growth. Yeah, I think that it is an issue that people do tend to look to growth as the end-all and be-all. I will say, as a general rule, if your economy's not growing, odds are things aren't good. On the other hand, you could have growth, and it might be very destructive growth. We could have sprawl. A lot of the growth we had in this decade, are building homes probably that shouldn't have been built in these distant suburbs. People have long commutes. It's not an end-all and be-all. One of the things, so just quickly, I can't go into anything your third point. There's so much going to cover, but one of the ways I see as an effective way to get us out of this is a tax credit for reducing work time. The reason why I like this, it's as shovel ready as you can get. And the basic point would be we have an employer tax credit, a very arbitrary number. Suppose we tell employers that we'll give you a tax credit up to 10% of the employee's wage or $2,500 for a corresponding reduction in work time of your choice. It could be paid parental leave, paid sick days, paid vacation, or just shorten the work week. Instead of working a 40-hour work week, you have people work a 36-hour work week. That's something that could be done in principle immediately. It would stimulate the economy, and the great thing, at least in my view, is at every level of GDP, you'd have more people working. So it could be a really quick, easy way to create millions of jobs. And to my mind, that's kind of an obvious way to go, because the thing that should drive everyone nuts here, we're poor not because we don't have the ability to produce things. I mean, we can produce everything we produced 2 years ago. We don't have less capacity in our universities, in our laboratories, in our factories. We can produce everything. We're missing demand. That's all we need. And it's like the stupidest thing in the world that people are going to go hungry, homeless, and unemployed because we're not spending enough money. So I think we have the ways out. We just have to be a little creative about it.
You didn't have much of a chance to go into derivatives. I wanted to ask you, how specifically would you propose to regulate derivatives? And are there some derivatives that are too toxic to continue, where you wouldn't have a particular category of derivative continue? And if I may, are there any lessons to learn from Venezuela?
I'm not sure about Venezuela on that, but in terms of derivatives, well, one thing I've talked about a lot, and I think I'd really like to push on this. I don't think it's a good argument except the power of the financial industry. We should tax financial transactions of all sorts, a very modest tax, because the model I used, he said a 0.25% tax on buying or selling stock. No one's ever going to like to pay the tax, but realistically, that's not going to be a big deal for someone who buys stock with the idea of saving for retirement or their kids' education or something. They can hold it for 10 years. So if we had a tax like that on purchasing stock, options, futures, all sorts of financial assets, it would reduce a lot of speculation. The second thing it would do is it would make the financial sector smaller. And I think that's really important in terms of regulation. Because the real story, to my mind, of regulation, or the failure of regulation in this period, wasn't that we didn't have people who knew what to do. We had people that wanted to regulate derivatives. Brooksley Bourne, who was the head of the Commodity Futures Trading Commission, she wanted to regulate credit default swaps and other derivative instruments in the late 90s. But the big boys, who all had close ties to the financial industries, Rubin, Greenspan, Summers, they said, no, we can't do that. It's a vibrant industry. You're going to kill it. You can't do that. Well, she knew the right thing to do. And there are other examples of regulators who knew the right thing to do, but they didn't have the political power. So I think it's not that it's so hard to figure out the right way to regulate them. And obviously for different instruments, there'll be different ways. The point is that the regulators have to have the power to do it. And that means beating down the financial sector, because obviously the financial sector doesn't want to be restrained. Basically, they want to take bets with our money. So unless we could control the power of the financial industry, we can have the most brilliant people in the world at the regulatory agencies, they won't, and the best laws, they won't be able to do it because the financial industry will use their power to override them. So I think that's really the key.
Mr. Baker, you nicely read the book very briefly. I looked at it and very informative. I'm Canadian, so I have very little access to Greider in this, but a nicely run country. Recently, banks are all solvent. But you call, I think in this book though, a little footnote explaining how difficult it is to identify a bubble may have been useful. Was it a bubble? How much of a bubble? It's very, very difficult questions for economists. You might have footnoted that. But at the same time, there's no doubt there's been bubbles. But you haven't answered, I think, what created the bubble. And the bubble, in my view, was excess liquidity in the economy for a long time. You've identified the villain, but haven't given the fundamental causes for a bubble. The bubble in housing and stock market, in my view, were continuous increases in liquidity by Greenspan for a long, long time. He injected liquidity in 97 to overcome the stock market. He injected liquidity, the Y2K problem in 2000, and it was never withdrawn. When you inject, you have to withdraw as well. That was never withdrawn. So given that background, if you believe partly what I say, because you do call him a villain here, I'm following up on the question earlier by the weird institution you call it, the Federal Reserve. It is a weird institution, but it's not for looking after the banks. If you look at the Constitution of the Federal Reserve, or the terms of reference, to look after growth, price stability, financial stability, everything good for the American people. Given that, what caused this incredible financial crisis to take place? Maybe we need to look at terms of reference of the Federal Reserve and give them a nominal anchor, like many Canadian central bank has, and other banks do. Would you support that? Give them a better nominal anchor? For example, there have been proposals to include house prices as part of the inflation fighting scenario. Many economists have come up with that. Would you support going that route? Question number one. My question number one is, would you support a terms of reference change of the Federal Reserve? No one has asked for that recently, but would you support that? The second question is the financial industry.
I think we better let some other people get questions.
Would you support,
it better be very
just one
quick.
question,
Yeah,
would
no,
you
let's start- let's
support,
keep- We do have to finish up. Let's keep the one question.
second question quick,
Real
would
quick.
you support a change in corporate governance of the financial sector board of governors, the board of governors of each company? Because that's what caused the problem.
Okay, first off, I didn't include any footnotes about bubbles being hard to see because they're very easy to see. I try and say that as clearly as I can. Let me just say it really clearly. Bubbles are very easy to see for a competent economist. They were incompetent or they chose to ignore them. Take your pick. I don't know which it was. Secondly, in terms of liquidity, that was a central part of it. They should have been on bubble patrol. It should have occurred to them that when you have a 1% interest rate that you're likely to see bubbles. It's a more likely environment. It doesn't mean that you'll get bubbles, and there's steps you can do to counter them. But on the other hand, you're more likely to see a bubble when you have a 1% federal funds rate than, let's say, you have a 10% federal funds rate as we did in the late 80s. So it should have occurred to them. So that was a necessary part, but it wasn't sufficient. You could have a low interest rate without having a bubble. So those didn't necessarily go together. In terms of their charter, he had ample authority. Greenspan had ample authority to take steps to counter the bubble. The wording of the charter, I mean, this is one of these things. This is just game playing. You know, you had Bernanke and Paulson, they were justifying that they didn't prevent the collapse of Lehman because they lacked the legal authority. That is a joke. I mean, suppose they had rescued Lehman. Was someone going to bring suit? You know, I mean, it's just silly, you know. So, you know, yeah, it should occur to you they're responsible for maintaining the stability of the U.S. economy. They interpreted that to mean in 1998 that they had to intervene in the collapse of long-term capital assets. They should have interpreted that to mean you have to attack a bubble. You know, it's utterly so they had the authority, they had the obligation. You know, I don't care if you want to put it in writing, but I mean, you know, basically, if you're at that level of power, you should understand this is part of your responsibility. The second point, in terms of rules of corporate governance, what I actually say about that, I don't mind more intrusive measures if need be, but we set rules of corporate governance already. I think what's very clear is that there's a real insider problem, that basically the people who run the corporations are the executives and they run it for themselves. They pay themselves huge salaries, the boards answer to them. And the shareholders, if you don't like the salaries your executives are getting, well, sell your stock. That's the easiest thing to do. So I think to make it more difficult for them to do that, what I would say is we should change the rules of corporate governance to have mandatory shareholder approval of executive compensation at regular intervals and real votes. I mean, it's kind of amazing. You get these votes where they get to count on-return proxies as supporting management position. I always say, it'd be like we had our representatives in Congress running for re-election, and they get to count everyone who doesn't vote as voting in their favor. I mean, this is absurd. Let's have real votes. So, and we set rules for corporate governance. So this is no increase. It's just changing the rules. It's no increase in intervention. It's just changing the rules.
Okay, I want to get back to bubbles.
Quick questions.
We've had bubbles from the tulip mania forward. There's a famous book many, many years ago called it The Madness of Crowds. But at least in those periods, you had a market price that you can identify whether it was too high, and people jumped aboard. When you created the derivatives, you created opaque securities, and they could not be identified in terms of market value. Then they got sliced and diced and sold worldwide, and they're still opaque to this point. And in '98, when Clinton signed a bill that got rid of the separation of banks and financial institutions, it allowed them the power to create all of these opaque instruments, which is part of the present bubble, but you can't identify value. What do you do about that?
Okay, well, in fairness to Clinton's group, they actually had that power prior to '98, so it didn't really give them the thing that he did sign, the Commodities Futures Modernization Act, or I'm mangling the name, in 2000, which prevented the regulation of most derivative instruments. But the simplest thing is to require that they be standardized as an exchange traded. I mean, that'd be the simplest thing. So it would get rid of that problem. So I'd be very strongly in favor of that.
So this is after the fact?
well, I don't know what we could do. I mean,
There's no value.
Listen, I and a lot of other people were saying this 10 years ago. We just weren't running the government. It was obvious this was going to be bad news. I mean, exactly what?
Well,
how, we
Greenspan,
didn't
when he
know.
was asked about it, said the marketplace will decide.
You haven't really talked a lot about incomes, and it seems to me the reason a lot of people took on so much debt from 2000 to 2005 and 6 is that the prices of the things that most people had to buy, like a house or an education, were going up, and their incomes were staying flat. So the only choice they had was to borrow. Well, if incomes aren't going to go up, if we don't do something to make incomes go up now, there won't be much demand, and banks won't lend to companies who don't have customers. So do we need to do something with the income distribution?
Yeah, well, certainly that is part of the story. So we had people borrowing. Not everyone borrowed was doing it because they lacked income. I mean, some of the people were doing reasonably well, and they thought, why not take money out of their home? But certainly there were a lot of people who were borrowing from their homes to pay their necessities in many cases. And, again, part of the story when I was saying at the onset the bubble economy was we had gone from this period where you had income growth being broadly shared to one where it was mostly going to those at the top end. Now, interestingly, where we go forward, again, we need to have a big stimulus. No mistake about that. Government should be throwing money out there. We should throw money at the problem. Literally, this is the time to do that. But the other part of the story is actually an interesting development. We'll have to see how this pans out. But there actually has been a very large increase in wages for those who still have jobs. The hourly wage has actually risen a lot over the last 6 months or so, and for things that some of us are familiar with. We've fallen gas prices. A lot of products that have been driven up in price over the last 3, 4, 5 years, they've fallen very sharply in price, and wages, at least thus far, have continued to maintain some decent rate of nominal growth. Now, I anticipate that will dissipate as the unemployment rate rises, but at least until very recently, last month's data, wages were rising at about a 3.5% nominal rate. So if you have 3.5% nominal wage growth and prices may be falling 0.5% or 1%, that's pretty good. So I don't know that will continue, but for now at least, that's actually a fairly good picture. But yeah, I mean, to my mind, economic policy is about ensuring that everyone's benefiting from economic growth. I think economic policy over the last quarter century or 30 years has been about ensuring that only the top, 1 or 5% benefit from growth, and that leads to both a bad situation for most of the country and obviously at this point a pretty bad economy.
Take two final questions.
Your comments this afternoon about the other side of the intergenerational transfer issue is something that hasn't seemed to get much coverage in prior discussions of your book and the general argument. Wondering if you were already doing this, but have you been giving some thought to getting out to places like George Mason or University of Maryland or GW and maybe getting Mr. Peterson and folks into a debate about that issue and getting it in front of the legislators as well?
Well, I talk about as much as I can wherever I can, and I would love to have a debate with Pete Peterson or, I actually have to debate David Walker, who's, a lot of ways a not bad guy. He's the head of his foundation, and I think he believes what he says. I don't think he's a liar. But, I would, let me put it this way. I take every opportunity I can to make this argument wherever I can make it. So I'm open to suggestions. There's only so many hours in a day, but if we could get out there, get a good audience, I'm always happy to do it.
Thanks very much for your book and your insights. There's strong differences within the progressive movement and liberals about whether there should have been a bailout in the first place for the banks, but now there's a lot of rising view that whatever the Obama people are doing right now isn't sufficient for saving the banks and saving the system and getting credit out there. What would be how could the progressive movement in general organize around, as part of its broader agenda, getting, making sure that the banking system is correctly and, aptly, set up so it gets lending out to the people who really need it? Because right now there's a lot of concern that it's not going to happen. And how could that be done in a way that could be effective, do you think?
Well, it's a tough question. Let me point out again, though, I think there was a lot of misinformation about the TARP. To my mind, at least, it was not about getting lending out there. It was about preventing the collapse, which was a legitimate thing, because there's this whole chain of debt that I didn't want to see collapse either, and it's not because I'm friends with the banks. I want to see but in terms of getting lending out there, I mean, there are banks that have managed to survive and not get killed. So some of the smaller banks. Actually, I was just looking at this morning that if you look at the kind of not the very smallest banks, but banks with assets between 100 million and 300 million. So they're relatively small, but not very small. those actually have increased their lending over the fourth quarter, the most recent data we have. So I take that to mean they're in reasonably good shape, and I think it'd be good policy to try to, get them more money, saying that, look, these big guys, whatever we do with them, they're going to be at least crippled, going forward. Now, in fairness, the big, if we take the institutions with assets of more than 10 billion, there's like 85 of them, their total assets are more than 20 times the assets of this group that I'm talking about. So you can't hope to run an economy just with the small banks. But, I think it makes sense to say, look, these were the relative success stories. Let's try to help them out, make sure they have adequate capital. And that'd be, I don't know if we can do it under TARP, or what's TARP called now, whatever the new name is, maybe another program. But it makes good sense to make sure that they have access to capital. The other part of the story, and this is something that has gotten, unfortunately, too little attention, again, talking about the Fed is actually giving out much more money through its various lending facilities than Treasury is through TARP. We can at least look up and go, okay, how much did Citigroup get from TARP? How much did they get from the Treasury? We have no idea how much they got through the various facilities from the Fed. The Fed discloses no information on that. I don't see any justification for that. I don't, if you're getting money from the Fed, why shouldn't we know that? It's an arm of the government that we should know if you're borrowing money. And they're saying if we made this public, their official line is, if we made this public, they'll be more reluctant to do it. I go, so? Yeah.
My question was, is there an organizing agenda or principle for progressives to get behind to help make sure this stuff is sort of done appropriately along the lines that you're suggesting?
Well, I think the best rule is transparency. I mean, try and get everything as much above board. Where's the money going? How much are the executives getting by way of compensation? And again, all compensation. We always get this game, when they passed the TARP last fall, there were a number of people running around talking about golden parachutes, no more gold. I'm not saying they have golden parachutes, but what the hell do I care? Maybe they didn't get a golden parachute, but we gave them $5 million through some other, we won't care about compensation. So let's get their compensation, make sure they're not getting rich off the taxpayer expense. So I think transparency is the best rule.